In this video, I'm going to show you how you may be able to upgrade your home in a few years without increasing mortgage payments, without saving funds for a larger down payment, or without taking on additional mortgage debt to upgrade your home. That sounds like a tall order, but bear with me as I walk you through the strategy that may allow you to accomplish this goal. I recently had a conversation with a gentleman who liked my strategy of paying off his mortgage years earlier, but was more interested in upgrading from his starter home into a larger home to accommodate his growing family. He wanted to know if my strategy was applicable in his situation. With the cost of housing today, most families begin with a starter home, perhaps a condo or a townhouse, with the hope of upgrading to a larger or perhaps better located home as soon as circumstances will allow. It is very common that there typically isn't any money to invest at the end of the month. You may feel like you're just getting by, and if you decide to upgrade to a more expensive home, you are relying on increased equity in your current home, as well as increased salaries to enable you to move up, typically taking on increased mortgage debt. Will my strategy work for you? Absolutely. In a previous video, Pay Off Your Mortgage Years Earlier, I explained how to do what the banks do, not what they say. What does a bank do? A bank takes money from depositors and promises them a return on their investment, usually a small return like 0.5% or 1%. And what does the bank do with those funds? They lend them out. They lend the money out in mortgages and other personal or business loans. They charge higher interest on those loans than they pay to the depositors, whose money it really is. In the case of mortgages, perhaps 3%. In the case of a car loan, perhaps 6% or even more. The bank collects interest on the loan, pays the depositor their promised interest, and keep the difference. This is called a spread. I live in Canada, and the products I use are available in Canada. I am sure identical products are available in other countries as well, but you may need to do a little research before you implement the mortgage pension strategy. I use 3 products for my mortgage pension strategy. The first product is an all-in-one mortgage that allows me to pay simple interest monthly without paying back any mortgage principal as I would with a traditional mortgage. This is an extremely important component of the mortgage pension strategy. The second product is a tax-free savings account or a TFSA, and instead of paying back mortgage principal like in a traditional mortgage, I invest those funds into a TFSA that compounds my earnings tax-free. The third product is a mortgage investment corporation, or a MIC for short, that invests in private mortgages. By paying simple interest only, the mortgage principal will not reduce like a traditional mortgage. Instead, the principal is directed to the compounding tax-free investment account. Effectively, I am borrowing at 3% simple interest and earning 9% compound interest. In time, the investment account may grow enough to purchase your upgraded home without taking on a larger mortgage. Let's look at our typical family, only this time we are looking at an 8-year time frame with the plan of upgrading to a larger home. Let's look at an example of how this works. So again, we are looking at our typical family. They have a home valued at $500,000 with a mortgage of $300,000 and a monthly payment of $1,400. Credit card debt is $15,000 with a monthly payment of $450 and a vehicle loan of $7,000 with a monthly payment of $400. Total monthly payments equal $2,250. The goal is to purchase a $700,000 home in 8 years. With the current traditional mortgage paying $1,400 per month, mortgage principal will reduce to $226,000 after 8 years. Effectively, the equity will increase by $73,000, which will now be used toward the purchase of a new home, leaving a shortfall of $126,000. The mortgage must increase by $126,000 in order to purchase the new upgraded home. Well, let's combine the total debt into an interest-only all in one mortgage. The debt remains the same at $322,000. That's a mortgage of $300,000, a credit card debt of $15,000, and the vehicle loan of $7,000. Interest-only payments at 3% are approximately $800 a month. Our total current payment is $2,250, which will now be split between interest-only mortgage of $800 and investing the difference of $1,450 into the TFSA. We are assuming an annual return of 9%. The current individual maximum deposit into a TFSA is $6,000 annually or $12,000 per couple. So we are assuming a couple will contribute $17,400 using annual contributions of $12,000 plus previous unused contribution room. After 1 year, the investment may have grown to $18,000. After 4 years, to $83,400. After 6 years, to $138,000. And after 8 years, to $203,000. So in 8 years, they may have accumulated the funds required to upgrade their starter home without investing any additional funds from their existing cash flow. I have included a link to a compound interest calculator on my website, mortgagepension.com. Put in your own numbers into the calculator and see how your particular circumstances will play out. If you found this video beneficial, check out some of my other videos and please hit the like button and consider subscribing to my channel. Thank you for watching.